Can hear you.
All
Good
right,
evening.
thanks. My name is Ashiwaju. I will be taking strategic financial management. Of course, we have two lecturers involved. The second lecturer should be coming up tomorrow, all things being equal. It's exactly 8:30. Please let just 1 minute. Now tonight, we are looking at corporate failure. But before I go into the topic proper, let's do an overview of what strategic financial management entails. The first point is financial management is an integral part of management that is concerned with how companies source finance, how companies utilize finance, so as to meet the objective of a business entity. I will take that again. Financial management is an integral part of company's management that is concerned with how companies source finance, how company utilize finance, so as to meet the objective of the business entity. Financial management will happen at the topmost level of the company. It involves all aspects of finance. And because we agree that the primary objective of a business entity is to maximize profits, is to make more money. Therefore, companies must pay special attention to their financial affairs. I want to explain this. If you look at that definition, we can expand this with explanation. Financial management. As a financial management student, you must understand the different sources of finance. If you go back to past question, check out diet in, diet out. Almost all diets for the past 10 diets, examiner will always take one question from sources of finance. For the past 10 diets, the examiner will always take one question from finance sources. What is so special about this topic? Why is it that all diets, a question will be texted from sources of finance? This is because that is the core of financial management. Finance sources is an integral part of financial management. Why we establish financial management is to explain to us as a company how we can solve finance. That means you cannot go to that exam without a good understanding of the various sources of finance. For you to go to that exam, you must understand the different sources of finance the company can utilize. You must understand the implication of each finance source. You must understand the benefits and the risk of each finance source. If you check last November question, examiner created a scenario around the topic source of finance, because this topic is core to financial management. All right. Now to the topic we are taking today. Corporate failure. Because you must be able to relate all your topics. We have up to like 25 topics to be treated for financial management. You must be able to find the linkage between all the different topics that makes up financial management. Precisely tonight, we are looking at corporate failure. What are the learning objectives here? What are the learning objectives here? One, you must be able to understand what is corporate failure. Why do companies fail? How can we prevent company from failing? What are the symptoms of corporate failure? What are the signs you are going to see in a company that will give you an indication that this company is likely to fail? Remember I said financial management or strategic financial management is an integral part of management that is concerned with how companies source finance, how companies utilize finance so as to meet the objective of a business entity. That means at every point in time, the company must consistently meet its business objective. Now, how does corporate failure come to this now? We have explained the fact that the primary objective of a business entity is to maximize the wealth of the shareholder. The primary objective of a business entity is to maximize the wealth of the owners. In a situation where a corporate company cannot consistently make sufficient profits to meet the expectation of the business owner, in that situation, we say there is corporate failure. Corporate failure. This is the inability of a company to consistently achieve satisfactory return in order to meet the expectation of the business owner. At any point in time that we observe that a company is not making sufficient return to meet the expectation of the business owner, then we say this company is experiencing symptom of corporate failure. If such situation is not checkmated, the company is likely to collapse. Now we have explained corporate failure. That where a corporate company cannot consistently achieve satisfactory return to meet the expectation of the providers of capital, then we say there is corporate failure. I will explain this. Our next discussion is what are the causes of financial distress? Because corporate failure will come from financial distress. Once a company is distressed financially, then that company will experience corporate failure. What are the main causes of financial distress? You know, we need to consistently challenge ourselves. What has happened to Heritage Bank? Heritage Bank has been declared non-fit as a bank. That means financially, that company has financial problem, or that company is not fit to run as a bank or as a company. What has happened to Heritage Bank? That will make Heritage Bank a bank that was established to achieve profit. Now, this bank was experiencing losses over time, to the extent that central bank has to declare this bank not fit. The bank, as far as we are concerned, is no longer part of bank in Nigeria again. What has happened to this bank? What has happened to Diamond Bank that led to the acquisition of Diamond Bank by Access Bank? As finance professionals, we must challenge ourselves that what is happening to this company. Now let's look at causes of financial distress. One of them is revenue failure. This may be as a result of loss of sales order or loss of market share, where a company is not generating sufficient sales. That company will experience revenue failure. Revenue failure will give rise to financial distress. Financial distress will result in corporate failure. If that situation is not checkmated, the company will eventually collapse. Revenue failure. Number two, cost failure. Cost failure may be as a result of weak cost control, a weak cost control, inappropriate accounting policy, exceptional or excessive cost burden. If a company is operating at higher operational cost, that company may experience financial distress. If a company operates inappropriate accounting policies, that company will have cost failure. Cost failure will lead to financial distress. Financial distress will result in corporate failure. So as an accountant, you must be able to understand the cost structure of your company. You must be sure that you are not running your business at higher cost. You must also ensure that you have adequate control structure, cost control structure. You must be able to manage your business cost. Otherwise, the company may experience cost failure. Cost failure will lead to financial distress. Number 3. Failure in asset management. Failure in asset management may include inappropriate investment in technology, poor working capital management, inappropriate write-offs, and reinvestment in assets. Failure in asset management. This could be as a result of failure to invest in appropriate technology. It could also be as a result of poor working capital management, or where you have inappropriate write-off, meaning that if a company is not making provision for the replacement of assets, if you look at depreciation, the concept of depreciation is that we are going to depreciate our assets every year so that we can make provision for funds for the replacement of assets when the need arises. So where you have inappropriate write-offs and reinvestment in assets, that will lead to asset management failure. Failure in asset management will give rise to financial distress. Financial distress will result in corporate failure. Number 4, failure in liability management. Please always remember, you are in final class. And an accountant, we are assumed to be in charge of the blood of a company. The blood of any company is the finance. It is the money. Our responsibility is to manage money in a company. Our action could either make a company or destroy a company. Our competency have impact on company's results. All right. Failure in liability management. This may include, or this may occur as a result of the inability to manage company's relationship with the money markets. Liability management failure may be as a result of the inability of a company to manage its relationship with the money market. This will also be as a result of poor interest rate risk management, or unsustainable credit policies. Any of these could give rise to failure in liability management. Let's explain items. The inability to manage company's relationship with the money market. What is the money market? Money market is a market for short-term finance. Money market is the market for borrowing and lending on short-term basis. Commercial banks operate within the money market. Definitely, at one point, company may need to borrow money on short-term basis. At some point, company may need to invest on short-term basis. That means as a company, you must maintain a cordial relationship with the money market. You access the money market to obtain short-term finance. You also access the money market to make investment on short-term basis. That means as a company, you must be able to manage your relationship with the money market, with your bankers. The inability of a company to manage its relationship with the money market could lead to failure in liability management. This could give rise to financial distress. Financial distress will lead to corporate failure. The second point is poor interest rate risk management. Definitely, if a company borrows money, interest rate will apply. And the rule of interest rate is the company must pay the interest rate at when due. That means there's element of risk. When you are obtaining loan, this loan will come with interest. Failure to meet the interest payment as at when due could be a major problem to company survival. That could give rise to liability management failure. Also, we talk about unsustainable credit policies. At some point, you may give credit to your customer. Your customer buy on credit to make payment at a later date. As an accountant or as the finance manager, you must define the credit policy. Now, when defining the company's credit policies, you must bear in mind that is this policy sustainable? If you are giving credit out, unsustainable credits, then you are putting the life of the business at risk. Because if you give goods out on credit and you are not getting cash back, how will the business survive? Imagine a bank giving loan to customer, credit, advancing credit to customer, and the bank is not thinking of how to recover the loan. How would the bank survive? So if a company runs a non-sustainable credit policy, that could give rise to liability management failure. Liability management failure will give rise to financial distress. Financial distress will give rise to corporate failure. And lastly, we have failure in capital management. This could be as a result of over or undercapitalization. Capital management failure may be as a result of over or undercapitalization. Or it could also be as a result of poor management of companies' relationship with the capital markets. Particularly when you are not monitoring, when a company fails to monitor its debt portfolio. Company must pay attention to its debt portfolio. When we say overcapitalization, if you are putting too much money to the business, you are injecting too much capital to the business than required. That is overcapitalization. And that can destroy the life of the business. Or if you are not putting enough capital to support your business, that becomes undercapitalization. That can also destroy the life of a business. That means a company must work towards adequate capital structure. A company must maintain an adequate capital structure. You must avoid overcapitalization and you must avoid undercapitalization. Also, company must be able to manage its relationship with the capital markets. What is the capital markets? Capital market is a market for long-term finance. A market where company can access long-term funds. You can go to this market and borrow for long term. Now, for a company to borrow, that means you must be able to establish a good relationship with the capital markets. At the same time, company must manage its debt portfolio. Company must not borrow excessive borrowing. You must avoid excessive borrowing. So any of this could give rise to capital management failure. Capital management failure will give rise to financial distress. Financial distress will result in corporate failure. All right. We have explained the meaning of corporate failure. We have explained causes of causes of financial distress. Our next discussion is corporate failure prediction, meaning that how can we predict companies that is or are the risk of corporate failure? You know, if you're able to predict that this company is at the risk of corporate failure, we can quickly advise the management to take action to avert eventual failure. Our main duty here is that we should be able to identify companies. We should be able to identify companies that is or are the risk of corporate failure. If you are able to predict that this company is at the risk of corporate failure, then we can inform the company's management quickly that your company is experiencing symptoms of corporate failure. And we are telling you to take urgent action to avert eventual collapse. Basically, there are two types of corporate failure prediction model. Basically, there are two types of corporate failure prediction model. We have the quantitative corporate failure prediction model. We have the quantitative corporate failure prediction model. We also have the qualitative corporate failure prediction model. These two models try to explain the likely causes of corporate failure. These two models try to explain the likely causes of corporate failure. The first model, quantitative corporate failure prediction model. This school of thought argues that companies fail because of financial problems. This school of thought argues that company fails because of financial problems. In this case, we should be able to use financial ratio to identify companies at the risk of corporate failure. If you look at the qualitative corporate failure prediction model, the argument of this school of thought is that company fails because of financial problems. If we agree with this, then we should be able to use financial ratios to identify companies at the risk of corporate failure. We can compute financial ratio to test if this company is at the risk of corporate failure. We can look at profitability ratio. You can look at profitability ratio. You can compute return on capital employed. or you can compute asset turnover ratio, or you can compute operating profit margin ratio. When you are computing this ratio, you are trying to assess if this company is at a risk of corporate failure. So if you take company financial statement for like 5 years, you can pick a company. Let's take Heritage Bank. If you go back to Heritage Bank problem, go and look at the company financial statement for 5 years. Subject the financial statement to financial ratio analysis. Check the profitability index or ratio. The profitability ratio will tell you the performance of the companies in terms of profits. To what extent is Heritage Bank generating sufficient profits? That will give you an indication that this bank has been experiencing problems for some years. You can also look at liquidity ratio. Liquidity ratio is to measure the extent to which a company is liquid, the extent to which the company have cash or cash flow to meet its financial obligation. Liquidity ratio is to tell us that, okay, to what extent is this business generating sufficient cash to be able to meet our financial obligation as at Wendy. Where a company is not generating sufficient cash flow or adequate cash flow, that could be a symptom, that it could be a sign or an indication that this company is experiencing signs of financial distress or signs of corporate failure. It could be a sign. Again, if you go back, take Heritage Bank. Now try to test the company liquidity ratio. As a bank, you must maintain some solvency ratio. You must maintain some level of cash. We call it solvency ratio. The solvency ratio, you must maintain some level of cash to meet your immediate financial obligation and your long-term financial obligation. If you subject this company called Heritage solvency ratio, you observe that that ratio shows that this company is not meeting enough cash. Before central bank will declare a bank non-fit, they will have looked at all options. So this is what the quantitative school of thought or quantitative corporate failure prediction model is talking about. This model is saying that, look, we can use this model. This model argues that company fails because of financial problem, because the company has financial problem. Now, if we agree with this position, that means we should be able to use financial ratio to test company's performance. And that will tell us if that company is at the risk of corporate failure or if that company is not at a risk of corporate failure. You can also compute Gearing ratio. You can calculate your gearing ratio. What is gearing? Gearing is the extent to which a company has borrowed money. The extent to which a company has obtained debt finance. You can use the gearing ratio to know if this company is at a risk of corporate failure. If a company is borrowing money, it is not wrong to borrow money. But a company must know at what point to stop adding debt finance. You cannot just be borrowing money to finance your business 100%. That means the lender is the owner of the business. The lender can wake up and withdraw your money. So company must maintain some level of what? Some percentage of equity in the business. And you must also maintain some percentage of debt in your business. You must not run the business at excessive debt finance. So we can use gearing ratio to test if a company is at a risk of corporate failure. This is the position of the quantitative corporate failure prediction model. That look, if you want to know company at risk of corporate failure, go and look at the company financial ratios, the company's financial performance. All right, we have explained this. When it comes to financial model, or when you are talking about quantitative corporate failure prediction model, a notable model under this school of thought is the Z-score. Z-score model. Companies or financial analysts usually use Z-score model to test if a company is at a risk of corporate failure. Financial analysts usually use Z-score model to test if a company is at a risk of corporate failure. What is the Z-score model? Z-score model is a mathematical model. The Z-score model is a mathematical model or a quantitative model that uses 5 key financial ratios. The Z-score model is a mathematical model or a quantitative model that uses 5 key financial ratios to test or to identify company at the risk of corporate failure. Please look at the screen, the Z-score formula. The Z-score formula is giving us I'm going to rewrite this. The Z-score formula is giving us the Z-score is equal to 0.012 x1 s subscript 1. That one is subscript plus 0.014 x subscript 2 plus 0.33 s subscript 3 plus 0.06 x subscript 4 plus 1.0 x subscript 5. This is the formula. Where x1 is equal to working capital divided by total assets. Our x subscript 1 is working capital divided by total assets. Your S subscript 2 is retained earnings divided by total assets. S3 is equal to profits before interest and tax divided by total assets. X4 is equal to market value of equity divided by the book value of total debt. And X5 is equal to sales divided by total assets. The Z-score model uses 5 key financial ratios to predict company at the risk of corporate failure. You can compute Z-score for any company. You know, a client can walk to you and say, I want to invest in, I want to invest in this company. I'm not sure whether I should invest in company A or company B. That's okay. Let me do Z-score for these companies. Take this formula and compute Z-score. The result of the Z-score will tell you if that company is at a risk of corporate failure or not at a risk of corporate failure. Please note with Z-score, please note these 3 points. A Z-score of 2.7 and above, if you compute your Z-score and you have above 2.7, this is an indication that the company is not at any risk of failure. If you compute your Z-score and you have a result of above 2.7, it's an indication that that company is not at a risk of corporate failure, meaning that that company is doing very well. Note number 2, if you compute a Z-score below 1.8, a Z-score below 1.8 is an indication that that company is at a high that company is likely to fail. Once the Z-score is below 1.8, then note number 3. A Z-score between 1.8 and 2.7 is categorized as gray area. If your z-score is between 1.8 and 2.7, this is categorized or classified as gray area, where there is possibility of failure, but it is not high risk. Where there is possibility of failure, but it is not a very high risk. The company may experience challenges, but the company is not at higher risk of failure. One major limitation of this model is that it focuses on financial performance. It uses financial performance to assess company. And in reality, there are some non-financial factors that could have impact on the company's survival. In most cases, non-financial factors have major impact on companies' survivorship. All right, we have tried to explain quantitative corporate failure prediction model. Please remember, this school of thought argues that companies fail because of financial problems. We now move to the second discussion. The second school of thought is the qualitative corporate failure prediction model. This school of thought argues that companies fail not because of financial problems. Financial problems are the consequences of corporate failure, not the causes of corporate failure. According to the qualitative corporate failure prediction model, they argue that companies fail not because of financial problems. In their own opinion, financial problems are the consequences of corporate failure. And they submitted that company fails because of non-financial problems. The major causes of company failure is because of non-financial problems. And they supported their position with a model, the Argentine model. The Argentine model. The Argentine model is a non-financial model that uses 3 non-financial reasons to explain causes of corporate failure. I'll take that again. The Argentine model is a non-financial model that uses 3 non-financial factors to explain reasons why company fail. They explain this under 3 major headings. They explain their position under three major headings. One is management defects, defects in management. That is one of the reasons why company fails is because of management defects. There's defects in management structure. What are these management defects? What are these management defects? Look at it, please. One, inexperienced managing director. Imagine running a company and that company is being led by an inexperienced managing director or an autocratic managing director. Imagine running a company where the managing director does not consult with any team member. He only issues direction or instruction, and every employee must comply. That is defect in management structure. Number two, under management defects. Under management defects, you can also have failure to separate the role of chairman and chief executive officer. That is corporate governance issue, where the chairman is also the chief executive officer. That's corporate governance issue. That's management defects. That means there's defects in the management structure. The same person is the chairman, is also the CEO. So who is going to checkmate the activities of the CEO now? Number three, under management defects, passive board of director. Board of director that is too passive. Directors that cannot participate in the activities of a company. You know, for companies management board, for you to be a director, it's assumed that you have the requisite knowledge and experience to be sitting as a board member of a company. We also talk about what we call lack of balance in the skills of the management team. When we say management team we comprise of different skill sets. Management team, you have the accountants, you have the IT professionals, you have different fields represented in the management. If there's lack of balance in the skill sets of management team, that's management defects. You can also talk of what we call lack of management index, where management is not sufficiently knowledgeable about the business. That's a major problem. You are the MD of a company and you don't know anything about the company's business. On what ground will you now be part of a management and you don't know anything about the company's business? Lastly, under management defects, inability to identify changes in the business environment, poor ability to identify changes in the business environment and to respond to these changes is a major issue, please. It's a major weakness in management. The management of a company should be able to identify changes in the business environment and must be able to respond to these changes. You must be able to know that the business environment is not static. Business environment is always changing. It's a dynamic environment. You must be able to respond to that environment. I'll give you a good example. I'm not marketing GT, but look at that GT concept, Fashion Week. Look at it and say, okay, we are going to dedicate 1 week, Fashion Week. If you look at the business environment, the youth are crazy about fashion now. 30 years back, the youth are crazy about knowledge acquisition. Please note, there is a difference between knowledge acquisition and certificate acquisition. 30 years back, the youth of 30 years were more committed to knowledge acquisition. The youth of today, it is not about knowledge acquisition. It is certificate acquisition. That's why if you bring a graduate, you'll be wondering, this person has gotten BS. So look at that concept GT brought, that the youth of today, their business is about fashion. GT introduced Fashion Week. You can't imagine the number of youth that will visit that Fashion Week. You cannot imagine the number of accounts that will be open from that process. The number of income the bank is getting from that process. You must be able to understand changes in your business environment. If you look at it really now, company hardly sponsor school debates. Company hardly sponsor educational program. Look at it very well. Company will sponsor big what they call Big Brother Africa entertainments. That is what this generation is crazy about. All right, I'll leave that. But please note, once there is defect in management, that company is likely to fail. Number 2, accounting defects. Accounting deficiency. That will give rise to wars. That will give rise to corporate failure. Accounting deficiency include 1, no budgetary control system. Imagine running a company where you don't have budgetary control. We don't have budget. We don't budget in our company. We are running the system anyhow. We don't plan for spending. That was no budgetary control. I've never seen a company run without budget. You just start your business. You don't draw budget. What is budget? Plan expressed in financial terms. The This is what we want to achieve. And this is the cost of achieving this plan. So imagine running a business without budgetary control system. That is accounting defects. And that company is likely to fail. Also, no cash flow planning. You don't plan your cash flow as a business entity. If you look at company, at some points, company may have excess cash. At some points, company may have cash shortage. That means you must have a cash flow planning. If you are running your business without cash flow planning, that is defect in your accounting structure. Then we'll talk about no costing system. You don't have a costing system in your business. A costing system will record cost incurred. We measure cost incurred. We categorize your costs. We also try to capture all costs and introduce cost control measures. So now, imagine that a company is running without a costing system. That means there's defects in the accounting structure. And defects in the accounting structure will result in, it's a symptom or it's a sign that, or could lead to corporate failure. Number 3, remember I said the Argentine model uses 3 main non-financial factors. What are these factors? Management defects, accounting defects. Number 3 is errors in action. Mistake that has been made. Errors in action. Mistakes that have been made. What is error in action? These are wrong decisions taken by the company's management that could have been avoided. When we say error in actions, these are wrong decisions made by the company's management that could have been avoided. Please note, where there's defects in management structure and defects in accounting structure, automatically there will be errors in action. Mistake will automatically happen. I'll repeat that again. Once you have management defects and you have accounting defects, automatically there will be errors in action. This is what we are saying. If you have an inexperienced MD as your MD and you have accounting defects, the man that is the MD is not experienced about the business. How would that man be able to make good decisions for the business? There will automatically be there will automatically be errors in action. That's what we are saying. I hope that point is clear. I want to say errors in action. These are wrong decision taking that could have been avoided. Examples of errors in action: overtrading. When a company is overtrading, for example, a company goes to borrow money to increase its revenue. You are not making say so. A company goes to borrow money and you are now using this money to increase your state value. Or you invest in a failed project. You can't identify viable projects or unviable projects. You invest as an MD, you invest in wrong projects. That's error in action. Or you are obtaining excessive borrowing. As the MD, you don't even know when to stop borrowing. You are just borrowing money to finance the business. You don't know at what point to stop borrowing. That will be a wrong decision for the business. That is wrong, error in action. So please remember, error in actions. These are wrong decisions made that could have been avoided. All right, we have explained the school tool of, we have explained the two models: the quantitative model, that is the financial model, and the qualitative model, the non-financial model. Assuming you are asked, what are the causes of corporate failure? Are they financial problems or non-financial problems? What will be your response? Assuming you are asked that, explain to us what are the causes of corporate failure? Why do companies fail? Are they financial problems or non-financial? What will be your response? Yes, you can actually unmute to speak. Okay, I have two responses. I have Esang, please pardon me if I'm wrong. I have Esang, non-financial, Ibikule, non-financial. Okay. If you look at it deeply, the major cause or cause of corporate failure are non-financial. In most cases, companies fail because of non-financial problems. If you are trying to achieve an excellent financial result, please monitor your non-financial variables. Let me repeat that point, please. If you are trying to achieve an excellent financial result in your business, please monitor the non-financial variables. What are non-financial variables? One, you must be able to develop and produce a good product or render what we call needed and qualitative service. People will continue to patronize you if you are giving them quality service. For example, punctuality, non-financial. You have to open the business by 8 and you are coming to shop 10 o'clock. Customers come in, they are not meeting you. You are creating problem for the business. Over time, they will be looking for elsewhere to buy their products. You cannot joke with your customer, non-financial. The extent to which your customer is getting satisfaction, the more you can get more business from your customer. Customer satisfaction, non-financial. So please, in most cases, companies fail because of non-financial problems. All right? Of course, if today's class, less calculation today. Symptoms of corporate failure. What are the signs or what are the things you are going to see that will tell you that this company is at a risk of corporate failure? What are the symptoms of corporate failure? 1, qualify audit opinion or audit reports in a row for many years. Please, what is qualified audit reports? What do we understand by qualified audit report, please? Yes. You can unmute or send response via chat. What is qualified audit opinion or audit report? Okay. If the auditor says that we have examined the company's book or company's financial statement, and we observe that these financial statements do not represent the true and fair view of the business. Auditor is saying that we have examined your financial statement, and we are saying that these financial statements in negative form. Okay, that's correct. The auditor is saying that we have examined your financial statement, and in our opinion, these financial statements do not represent the true and fair view of the business. It means that there's something wrong with your financial statement. And by extension, something is likely wrong with your company. You are not presenting the true financial position of your company for us. You are hiding some information. The only reason why company will hide certain information in most cases, why company is hiding certain information in most cases is when the business is having challenges. You don't want the public to know. In most cases, why company hide certain things beyond tax evasion, tax reduction purpose. In most cases, company will be hiding certain things because that company is having problem, and they know that if public should know, that will be a major issue. So the auditor will now look at it and say, no, we have audited this account, and we are saying that these accounts do not represent true and fair view. That's a symptom of corporate failure. The auditor is warning us now that, look, this company, is not doing well. It's hiding something for us. That could be a symptom of corporate failure. Number two, high staff turnover, where employees are leaving the company in their numbers. In fact, when a company has problem, you notice that it is the key staff that we know first, and they will start taking their leave. The key staff, we know that this company is having problem. They will start leaving the company to quickly look for another job. We talk of low interest cover ratio. What is interest cover ratio? The interest cover ratio shows the number of times the company's operating profit covered interest payments. Interest cover ratio. This is the number of times a company operating profit covers the interest expense. Now, if you compute interest cover ratio and you observe that this company has a low interest ratio, it could be a sign of corporate failure. That means you don't have enough profits to pay your interest. And interest is a fixed cost. It must be paid. Whether you make profit or not, you must pay interest on the loan. And if you cannot pay interest on the loan, then the lender can force the company into liquidation. That means low interest cover ratio could be a sign of corporate failure. You can look at extended overdraft. If you are taking overdraft, instead of repaying, overdrafts are short-term borrowing, or yes, short-term borrowing, overdraft. These are short-term facilities. If you are now extending the overdraft, maybe you are supposed to borrow for just 2 months. After 2 months, you extend again. You can't repay. You are now extending. Extended overdraft could be a sign of corporate failure. Senior management leaving the company. Fall in company share price. Dependency on a single or few customers or suppliers. That's a clear sign of corporate failure. That clear, please. Poor financial ratios could be a sign of corporate failure. Use of creative accounting, that is window dressing. When you doctor your financial reports, that's a clear indication of corporate failure. When you doctor financial figures, at least you must be able to go with 5 of these to the exam. Lastly, how do we avoid, of course, these are part of it, how do we avoid corporate failure? As a business or as a company, how can we avoiding corporate failure? How? How do we avoid corporate failure? If you look at the ICAN study path, they have given us a guidance. that as a company, you must comply with these 10 commandments if you are to avoid corporate failure. If you are trying to avoid corporate failure, as a company, you must comply with the 10 commandments. What are these commandments? 1, you must have a strategy. As a business entity, you must have a strategy. You can look at companies. Look at companies. Like of Dangote Cement, Elephant Cement, Boa Cement. Let's take Dangote Cement, Boa Cement. What is Dangote Cement strategy on how to get sales? There must be a strategy on how to achieve our sales. You must have your unique strategy. Boa Cement. What is Boa Cement strategy on how to get customers to buy their cement? You must have a strategy. If you look at banks, virtually all banks, they do the same thing. Zenith Bank, GT Bank, First Bank, they sell the same products. But why will a customer prefer First Bank to another bank? That means First Bank as a brand must have a strategy on how to get customers to open accounts with them. Other banks too must have their own strategy. So as a business organization, you must have a strategy on how to achieve your objective or how to get more clients to your business. Point number 2, you must have controls. Company must establish controls. If you go to a company, at the security gate, at the gate, somebody is there. You cannot just walk in. That's control. At the entrance gate, somebody is positioned there. It's part of control. Again, the employment process is part of the control. The company must be able to source competent staff for their business. They must look for a way to hire the right person at the right time. That means there must be a control for employment process. So there must be control. Number 3, the board of directors must participate. Meaning that the board of directors must be active in the activities of the company. Company's board is not National Assembly, where you can just go and be sleeping. No, it's easier for senators to go to National Assembly and sleep. Whatever they are discussing, it doesn't even affect anything anyway. Somebody is representing a constituency, and you are in Abuja. They are discussing issues. but you are sleeping as a senator. That can happen in National Assembly. It cannot happen in company's board. You must be actively involved in the activities of the business, of the company. Number 4, you must avoid a system of one-man rule. That means the MD should consult with his team and employees as much as possible. Get their input into the business. Only the MD cannot run the company. You have staff at different levels. You must reach out to them to get feedbacks and to get their input on the business. Getting the employees' input does not mean we are going to accept the input. But at least they must know that at least we are contributing to the business. Number 5, there must be management index. Management must be sufficiently knowledgeable about the business for you to be at the board, to be as part of management of a company. It is assumed that you have gotten the requisite knowledge and competency for you to be sitting as part of management of a company. If you are saying you are part of management, you must have spent some years working. You have acquired experience. You have acquired knowledge. You are now sitting as part of management. If you are discussing the business, you can contribute sufficiently to this discussion. We must have confidence that the management team is sound enough and knowledgeable enough to run the business. In most cases, if a client is planning to invest money, the first thing you are going to do is to check the management. What is the management team of this company? Go and check their track record. In most cases, beyond financial, if you want to invest in company, you are going to look at the track record. Okay, let's take this scenario. Please, this is just for class purposes. It's for learning purposes also. Imagine that we just wake up one day and we got information that MC Oluomo is going to be the MD of Zenith Bank. So he's going to be the chairman of Zenith Bank. That we just got information that, oh, MC Oluomo, the popular transporter and all this, their transport business owner, is now going to be the MD of Zenith Bank PSC. What will come to your mind? The first thing that we ask is that how will somebody from this background be the chairman of a bank? What is the requisite knowledge and experience that will qualify this man to be chairman of a bank? If that mistake is made, automatically the share price of the company will drop. So there must be management towards in-depth. Number 6, you must keep yourself informed of changes. as a company, you must keep yourself informed of changes in the business environment. That means you must quickly be telling yourself, what are the changes that is likely to happen in the near future? And how do we react to these changes? Like what happened like what happened last year? Last year towards October, September, banks are to recapitalize. So you need to move from used to be 5 billion, and CBN say banks should capitalize. I can't remember, maybe it's 20 billion now or 500 billion. That means you want to recapitalize, you need to increase your capital base. That means you must talk for money. The like of Zenith, Fidelity Bank, FCMB, GT Bank, they went to stock markets, issuing shares to the public. They are trying to raise money to meet the demand of CBN. That banks, commercial banks, should recapitalize. Increase your capital base. You must be able to identify changes and react to these changes. Number 7, the customer is king. Please always remember, when you are serving your customer or your clients, the customer is doing you a favor by bringing his business to you to do. You are not doing the customer a favor by serving the customer. The customer is doing us a favor by coming to our company to do business with us. We are not doing the customer any favor by servicing the customer. At every point in time, customer is the gateway to income. For any business, it is your client that is bringing money in. And you must always treat them as king. Number 9, do not misuse. Number 8, do not misuse computers. How does this help us to avoid corporate failure? Please do not misuse computers. If you are hired in a company, the company will give you access right to the computer. You have your password to log into the computer system. You have password to log into certain application. You have password to obtain some information about the business, about the company. This information is given to you in trust. We don't expect you to use this information to hurt the company. Every company has a business secret. And these business secrets is known to few employees. They have the password to access this information. If you are given these assets to be able to access some business secrets, do not use these secrets in a way that will destroy the business, because computer might call you, or they may even hire you. Maybe you are working with company XYZ. Let me take a good case. The issue of Indomie noodles. That unique taste of Indomie. Other companies doing noodles, they could not achieve that unique taste. If you look at other brand of Indomies, the original Indomie noodles, other companies could not achieve the taste of Indomie noodles. And that was they were trying to, computer was trying to get that unique taste. They want to know what and what that Indomie noodles has put together to achieve the unique taste. So what we are saying is that do not misuse your rights to the computer system. Nine, do not manipulate your accounts. This, do not manipulate companies' accounts. If you are trying to manipulate their accounts and the auditors, the external auditor cannot check your account, they don't know the true position. You are hiding it. In the long run, the company will collapse and you won't be able to blame the auditors. Because auditors will only work with the information you are giving them. If you are manipulating accounts and we don't know, you can't blame us for your failure. Because the auditors are not they are not witch or witchcraft that will be able to know what you have eaten. They will look at what you have submitted for us to audit. How do we get this material? The material was shared today now. If you are on the online platform, the material was shared today. Lastly, organize to meet the needs of your employees. If you want to avoid corporate failure, as a company, try to meet the needs of your employees. What we call company is actually the staff that work there. At the end of the day, we are going to close and lock the company. They say company is closed. Who has closed? The employee has closed, they have gone home. Tomorrow morning, we are going to open the business. Who has resumed? The employees has resumed. What we call company is not the physical structure. What we call company is the staff that make up the company. If you go and look at Microsoft said, I don't have employees. I have owners, I have stakeholders. Every employee is seen as what? As owner of the business. They don't see themselves as collecting salary. That we want to develop a software that will go over all the countries in the world. Are we not using Microsoft Word now? We are using Microsoft Word. Is there any country now that is not using Microsoft Word? They are not saying that we are here to make just profit. We are going to develop a software that will flow through every person. Once you are using computer or anything electronic, you are going to see the hand of Microsoft in it. It is the passion of the employees. They see the company as their home. This is our dream. So as a company, you must be able to identify the needs of your employee and try to meet the employee's needs. Please, need is different from wants. What do these employees need to be able to do their job effectively? Not what the employee wants. You are going to ask yourself, what do this employee need to be able to do their job effectively? Part of it is an adequate salary payments or package. There must be adequate compensation for job done. There must be a career path. The employees are not actually beggars. They are selling their service and you are paying for the service. And you require the services to be able to grow. Sorry, I have a technical glitch, but I'm back. Yes, any question, please? Any question? We are done with the topic. Of course, the first topic. Any question? All right. If there's no question, let's just run through Z-score calculation. You know, when we explain Z-score, how do we compute Z-score? You may be asked, although it has not been tested before now, but again, nobody can say this is what will happen. As you know, you are asked to compute a Z-score and comment if this company is at the risk of corporate failure or not. Assuming you are asked to calculate the Z-score or use the Z-score model, you are given like 3 companies' financial statements, and you are asked to use Z-score model to identify companies that is at the risk of corporate failure. How do we compute Z-score? Look at the illustration. Look at the illustration. Okay, we are going to reshare after the class. Anthony, don't worry, we reshare after the class. All right, let's look at this question and round up the class. We have Davidson Company has the following financial data selected from its financial statement. Total assets, 2,000 million. Retained earnings, 750 million. Earnings before interest and tax, 266 million. Sales, 3,000 million. Market value of common and preferred stock, that is the market value of equity. Your equity is the common stock, ordinary shares. And you also have your equity include ordinary shares and preference shares. Your preference shares is the preferred stock. Book value of debt is also given. Required. Calculate the Z-score. Assuming you are faced with this for like 3 marks or 2 marks, let us see how to calculate the Z-score. Of course, you are going to state the formula for Z-score. The Z-score formula Z-score, the formula is 0.012 x subscript 1 plus 0.014 x 2 plus 0.33 x 3 plus 0.06 x 4 plus 1.0 x 5, where x1 is equal to working capital divided by, let me take that, divided by total assets from here, x2 is equal to retained earnings divided by total assets x3 is equal to earnings before interest and tax divided by total assets X4 is equal to market value of equity divided by book value of total debts, and X5 is equal to 6 divided by total assets. If you look at it, just what you need to do is just to pick all your variables and compute. So we have stated this formula. We can compute now, page 2. The first one, X1. Go back to the question. What is the working capital in this question? Remember, working capital is current assets less current liability. But this question has been kept simple. Working capital is giving us, the working capital in the question is giving us 400 million. It's an omission on my part, but in the question is shown as 400. So with this, we can compute now working capital over total assets. Total assets is 2,000. Working capital is 400. I can come here. This is equal to 400 over 2,000. Please work this ratio out. That's our X1. Our X2. Retained earnings over total assets. Our retained earnings 750 over 2,000. This is 750 over 2,000. Please work this ratio out. You can respond via chat. Let me check. 0.2, thank you. $0.2. What do you have here? For X subscriptory, profit before interest and tax, that is 266 over total assets, 2,000. Let's work this out. 0.375, ubiquity, thank you. $0.375. S4 0.133, the 0.133, our X4, market value of equity divided by book value of total debt. Let's check it. Market value of equity, look at equity, common and preferred stock, that is equity stock, 1,425 divided by book value of debt, 1,100, 1,425 1,425 divided by 1,100. What do you have here, please? $1.297, 1.29, $295, not 7. Then X5, sales over total asset. Wait, so yeah, sales over total assets. This company is doing well now. You are making more sales. 3,000 divided by 2,000. 3,000 divided by 2,000. That's 1.5 now. We now go back to the formula. Our Z score is equal to 0.012 brackets X1. X1 gave us 0.2. Plus 0.014 bracket X2. $0.375. $0.375 plus 0.33 brackets 0.133 plus 0.06 brackets 1.295 plus 1.0 bracket 1.5. Please, I can see, okay, that should be correct. 1.629. So what would be your comment about this company? 1.629. What will be your comment about this Davidson Limited? Of course, like we said, if you compute your Z-score, let me look at it. Yeah. Once the Z-score is less than 1.8, it's an indication that that company is at a risk of failure, high risk of failure. That is how to compute Z-score. All right. I think we are good. We are good with today's topic. Any question, please?